The investment firm Janus and Henderson recently published a new study on the REIT sector that found out that they are currently priced at a roughly 30% discount to their NAV, which is a similar valuation to the times of the great financial crisis. What this essentially means is that you have the opportunity to buy an interest in a portfolio of real estate at roughly 70 cents on the dollar with the added benefits of liquidity, diversification, professional management, limited liability, and many other advantages that REIT offer. And that's not all. This 30% discount is just the average of the sector. There are a lot of individual REITs that are actually priced at closer to a 40, 50, or even 70% discount to NAV in the most extreme example. In today's video, I want to highlight some of these opportunities that I'm buying today. Hey everyone, this is Yossi. I run a small investment firm that specializes in REIT investing. And today's video, I want to highlight you 3 REIT investment opportunities that are trading at huge discounts to the net asset value. In my mind, these are once in a decade type opportunities. We really rarely see such large discount to NAV. But before I get into it, I want to remind you that we currently have the free trial active at my REIT newsletter. I'll put a link somewhere in the description of this video if you want to access my entire REIT portfolio. So the first REIT I want to discuss here is called BSR REIT, ticker symbol HOM.U in Canada and BSRTF in the US. This is an apartment REIT that specializes in Texan apartment communities for the most part. These are Class B affordable type communities that generate recession resilient cash flow. Even today, trends keep growing at a solid pace. Despite that, it's priced at a huge discount to its net asset value. Its current share price is $13 per share, but the company's latest NAV is $22 per share, so that's a roughly 40% discount. This would imply that this is a low quality REIT that's going through some severe difficulties, that it either has a poor management team or too much leverage or a declining cash flow, but none of this is true. It's quite the opposite. The company has a very good management team. It's cost efficient. They have a lot of skin in the game. They're actually the biggest shareholders of the REIT themselves. They're currently buying back shares to create value for shareholders. They have a strong balance sheet with a roughly 35% LTV. That's very conservative. And then the company has attractive growth prospects. Last year, same property NOI grew by over 10%. This year, obviously, this is slowing down a bit because new supply is coming to the market, but still expected to be in the mid-single digit rate, which is still solid. This is organic growth. It doesn't require much capital from the REIT. So this is a REIT that I'm accumulating a lot at the moment because essentially it gives me the opportunity to buy a small interest in a portfolio of Texan apartment communities, mostly in Austin, Dallas, and Houston, which are rapidly growing market with attractive long-term prospects at just 60 cents on the dollar. And then I get all the other advantages of having a REIT, cost-efficient management, economies of scale, you have liquidity, diversification, all these things that I wouldn't have if I would buy a property myself, and I get it at a large discount. I think that eventually, as the market sentiment for REITs recover, we're gonna see a repricing of the share price closer to the NAV. As recently as in 2021, BSR was actually priced at a small premium to its NAV. So if it returns to that level, the company's share price would actually need to double from here. But even if you have a more conservative estimate of the NAV, there is at least 50% upside from here, I believe. And while I wait, I earn a 4% dividend yield. The cash flow of the REIT keeps on rising by roughly 5% per year. And so overall, the risk reward is very compelling here. Before we go into the second REIT, could you please make me a favor and like this video if you find this content valuable? It will help us to get this channel in front of more people. Thank you very much. Then the second REIT that's heavily discounted and I'm buying at the moment is called Alexandria Real Estate, ticker symbol ARE. We've highlighted it quite a few times on this channel. I'll put some link on the screen so you can watch our other videos. But in short, this is a blue chip type REIT that specializes in life science buildings, has a strong BBB+ investment grade rated balance sheet. Its rents are growing rapidly today because there's a lot of demand for lab space in the post-COVID world, but not enough new supply is being built because these properties have high barriers to entry. Its rents also below market at the moment, and this is allowing the REIT to bump its rents by over 20% as leases expire. It's a REIT that has a great track record, one of the best in the entire REIT sector, outperforming even companies like Berkshire Hathaway. It has a lot of development projects on the way also with very attractive expected returns. And so all in all, this is a great REIT. Really little negative to say about it. The current share price of the company is about $110 per share. We estimate that its NAV is closer to $200. So once more here, you have a 40% discount to NAV. Even if you're more conservative than us with the cap rates, and let's say your NAV estimate is closer to 150, even if you're more conservative than us with your NAV estimate and you use a higher cap rate, you'll still see that there is so significant margin of safety that there probably would be still quite a lot of meat on the bone, quite a lot of upside in this case, because the company is so heavily discounted. And while you wait for this upside to be realized, you earn a 4% dividend yield. The cash flow of the company is expected to keep growing at 5 to 7% per year. And the management even has a plan to unlock this value. It's currently in the process of selling some assets, selling JV interest in some specific properties. It can then use this capital to reinvest in growth. It's also going to prove to the market that these assets have a lot more value than what's currently implied by the market price. So again, I really like the risk reward here because it's a pretty conservative company. It has steady growth prospects, and I get the opportunity to buy my stake in this portfolio of real estate at just 60 cents on the dollar. Then the third and final REIT I want to highlight here is called Vonovia, ticker symbol VNA. This is the biggest apartment landlord in Europe. Most of its apartments are in Germany, and currently its share price is about 17 euros per share. Its NAV is in the mid-50s, so that means that the discount is up to 70%. The discount has gotten so extreme here because the market is very worried about Europe because of the war in Europe, the high inflation, the rising interest rate. And so the market is greatly worrying here about what's going to happen to the NAVs of these companies as cap rates expand. The rental income is not rising quite as fast to compensate for this because of how rents are regulated in places like Germany. At the same time, some debt might come due, which might become more difficult to refinance if the asset values come down. And so as a result, the market is very worried and share prices are heavily discounted. But here again, I think that the fears are overblown. I've done some separate videos on Vonovia in the past. I'll put a link somewhere on the screen so you can go watch them if you want to learn more. But in short, the company has a BBB+ investment grade rated balance sheet. It's quite conservative. Sure, it has a fair bit of leverage, but this leverage is structured in the conservative way with fixed interest rate, long debt maturities. The maturities are well staggered. The company is able to sell assets to pay off maturities. It's also retaining a lot of cash flow to pay off debt. And so I'm really not nearly as worried as the market about the financial health of the company. At the same time, the company's same property NOI is rising by 3 to 4% per year, which may not seem much given how high the inflation has been in recent years, but because of how rents are regulated in Germany, these rent hikes are very consistent and predictable. They're happening each year, and so it really adds up over time. Ultimately, I think that the company's NAV is going to come down quite a bit as cap rates expand, but I don't think they're coming down nearly as much as the market is today predicting. Even if you assume that the NAV comes down from the mid-50s to mid-30s, the company will still have over 100% upside potential from here. You also get paid a 4 to 5% dividend yield while you wait. The yield is not particularly high here because the company is retaining most of its cash flow to pay off debt, which I think is a good thing because it makes the investment more tax efficient for us foreign shareholders. There's less withholding tax impacting our investment, and the REIT is able to retain all of this cash flow to pay off debt, which is eventually going to address the concerns of the market. My current thesis is that as Vonovia announces more JV sales or asset dispositions, this is really going to help its market sentiment as the REIT pays off debt maturities of the coming years and removes these concerns of potential refinancing issues. And then ultimately later on, a few years down the line, as we get inflation back under control, interest rates are also likely going to come back down, and this should really lead to a rapid repricing of the stock to a higher level. So these are three companies that are heavily discounted relative to the value of the real estate they own, but there are many others. Currently in our core portfolio at High Yield Landlord, we hold about 25 such names. We diversify in order to mitigate risks. If you want to access this full portfolio, feel free to join my REIT newsletter for a 2-week free trial. I'll put a link in the description of this video. And otherwise, once more, thank you very much for your interest and your support. We really appreciate all the people who like this video. It helps us a lot. Thank you very much. At the next one. Bye-bye.